All right, Double A, it's good to talk to you. I haven't recorded a video in a while.
Yeah, I haven't seen you in a minute, Mike. Good to see you.
So the purpose of these get-togethers is to quickly review the market. We're going to limit ourselves to just a few data points, but it's also the secondary purpose is to help explain the underlying data behind cheat sheets, so that when you see the uber simple presentation, you know that there's a lot of complex stuff behind it, if that makes sense.
Yep.
And try to keep it simple. All right, so I'm going to try to make this work. We're trying to get used to Google's less than intuitive system here. And I'm going into slideshow mode, and you should start seeing slideshow mode and all my charts.
Yes, I see your beautiful
Look at
charts.
that.
Mm-hmm.
So I want to focus just on 5 ETFs here. And they're the big ones, the things that most people are caring about right now. Obviously, stocks. So I've got S&P and NASDAQ. And then Bitcoin, because that's doing very well right now. Gold. And the treasury market, long-dated treasuries expressed in the form of the TLT.
Okay.
So I think those 5 ETFs, more than anything else, are a good barometer for what's going on in the broader U.S. market in particular.
Yeah, a good 30,000-foot view with those.
What I'm not including is international ETFs in general. If you've been following cheat sheets at stockcheatsheets.substack.com, you'll know that basically emerging markets and most of the developed ex-US stock funds are doing a little bit better, at least up until maybe this week, where we started to see the US finally rotate back into favor. It's all being driven by tech.
Yes, I've noticed that.
Yep. So more of the same, continuation pattern. NVIDIA beat earnings yesterday. You know what? I did look up NVIDIA because I thought, geez, that price action is just parabolic, and it has been for a year. But you know, their PE multiple against expected forward earnings is only 25. I mean, it's high, but it's not high flying as in, you know, Cisco Systems with 100 PE multiples back in 1999.
Right. Yeah, I guess that's a little surprising. I didn't notice that. I did, and I'm not an NVIDIA expert, but I will say there was some interesting news today about that if the way they did their accounting, it may not have been the beat that the headline suggests.
Got it.
So wait and see how that shakes out and how it's interpreted.
We're not going to go over individual stocks today, but I will point out that you and I have had much better luck instead of looking at price to earnings multiples, because the E part of that equation can get manipulated with tricky accounting practices. We've always and this isn't us. Mark Chaikin taught us how to do this, which is the price to sales revenue, because it's much harder to bullshit through top line revenue.
Yeah.
Right. So your sales are what your sales are. You pay commissions on them, and you set your margins based on them. So it's hard to manipulate price to sales.
Yeah.
Not impossible. Hey, see the smartest guys in the room, Enron, for more on that. All right. So let's look at, and now I've got to figure out how to advance the slides, Double A. So,
okay.
Yeah, there we go. So you should see 5 key index ETFs.
I'm still seeing your cover sheet.
You do not. Yes.
Yeah.
Yep.
I'm still seeing tailwind percent ranking.
Yep. And can I just tell you how much I think this sucks? Share this tab instead. Now you should see 5 key.
Now I see 5. Yes.
All right. I think we got it here. Okay. So tailwind score, remember, is a proprietary metric that's based on really publicly available data. It's just the way we combine the 10 inputs to feed the proprietary metric that really that's what makes it special, I guess, if you want to call it that. But it's 10 factors. Some of them are what we call forward indicators, and I actually place a little bit more importance on those. And we could basically break things up into kind of 3 categories. We have our moving average lines, long, intermediate, and short-term trend. And it's simple 10 versus 40 moving average relationships on a weekly, daily, and hourly basis. So the short-term trend, when we see factor 3, it just simply means the 10-hour moving average is below the 40-hour moving average. So it's literally a 5 trading day kind of system.
Yeah.
And then the intermediate trend, which is the one we focus on. So that's why we kind of like looking at the trend that's junior to our principal time frame, and obviously the weekly time frame is senior to our time frame. You know, the more time frames are all going in the same direction, the better. But obviously what I really like is having the intermediate time frame, that is the 10 above the 40 daily moving average, and then the long-term moving trend, which is the 10-week moving average above the 40-week moving average. When those two especially are swimming in the same direction, it's we're much more likely to be in a longer-term uptrend.
Yeah, you're trying to put as much wind at your back as you can, capturing different time frames in the trend of
exactly.
Yeah.
And in an ideal world, we'd like those two time frames, factor 1 and 2, to be bullish, while factor 3 is actually bearish, because that gives us the opportunity to buy a pullback and a rising. So the tide is in your favor, but maybe the wave is pulling back, getting ready to rip forward another another big wave.
Right.
So the first three metrics we generally like to see when we're in an established trend, we like to see bullish, and then bearish, but we don't want to be too bearish. And I think that's maybe the first thing I can point out here. One of our earliest warning systems would be the two factors on the right. Now, I'm not sure what's driving this, but Bitcoin got hammered into the close today. And I suspect it's because of the relationship between the dollar, bonds, and then equities. We did see the 10-year treasury spike up, not the yield, but the actual underlying bond price spiked up today, and the yield fell.
Yes.
And so that's kind of deflationary, I guess, so to speak. And whenever we see the yield go down like that and bond prices go up, that's generally kind of the first indication of a risk-off move. And Bitcoin, which is, some would argue it's digital gold, so it behaves like gold and a hedge against dollar currency devaluation. But I think also, I think it could be argued that Bitcoin is a levered up version of the NASDAQ.
Yeah, and we've talked on this before, is that crypto, in particular Bitcoin, also is just like a representation of liquidity, right? So it's just, it moves with the money supply. It moves with liquidity, as do the other a lot of the other asset classes too. But Bitcoin in particular, it seems.
So we love tailwind scores that are 60 to 85%. That's generally the Goldilocks score. Anything above 50 is bullish. Anything below 50 is bearish. But within that kind of spectrum of 50 to, and we actually have a few extra credit points, so it goes up to 104%. When we have all 10 factors extremely bullish, and then but the momentum is pinning the highest end of its range, we get a little extra credit. And so that's why the scale is up to 104. But 60 to 85 represents sort of the sweet spot for the tailwind score. If you take nothing away from this video, whenever you see my email newsletter, which you can subscribe to with the data tables on it, 60 to 85 is good. 50 to 60 is early, but it can be good. And we can talk about other things that you can look at when that's the case for potentially trends that are just getting started. And then, generally above 85, it certainly doesn't mean things are about to turn bearish, but it could mean that multiple time frames are overextended and that all of the bullish money that's easy has been made. And, we're probably closer to it could be nothing more than a sideways consolidation than we are to a major rip to the upside. So once you're above 85, just recognize the fact that there's more risk of the trend cooling off.
Kind of at that point, most people are in the trade already, so there's going to be less new demand to push it higher. Yep,
exactly right.
Okay.
So right now, what we're seeing with most major ETFs, with the exception of treasuries, the 20-year treasury bond proxy, it's basically a composite of the 10s and 30s. The TLT, that is in a secular downtrend, meaning the long term and the intermediate term are down, while we are now seeing a slight bullish improvement in treasuries. All of the other kind of more risky assets, so the gold and Bitcoin and stocks is what we're looking at here. Those are all in uptrends and in what I would call optimal tailwind positions. So if you look at nothing else, factors 1 through 3 in the tailwind score basically give you the barometer for what the big picture is in the market. And then there's some subtle ones. I can actually skip over 5 and 6, and we're going to focus on factor 4 and then factors 7 through 10.
Okay.
So factor 4 is probably the most important factor when you're in an established uptrend and the market is pulling back. Buying pressure is basically our word for a metric that is another Chaikin metric called money flow. Maybe you can give me, I know you like the force index as a technical trader, but really force index, money flow, all of these things are essentially equating higher prices with high volume.
Yeah.
To create a kind of a magnitude of buying pressure.
I like your term buying pressure. I like that term.
Yep. So, we are small time investors, although I would say the retail, because of retail money indexing, retail, it turns out in this rally is a pretty powerful force.
It's huge.
Yeah. I think I read somewhere that a week ago, Monday, $4 billion moved into the equity markets in one day, and it was all retail money.
It was the most, that was an interesting stat. I read that it came from JP Morgan. It said that it was the most retail money that plowed into stocks in the shortest period of time. It was about 3 hours.
Working millennials and Gen Zers who've never seen a bear market other than, I think the worst bear market we got was a 2-month summer pullback in 2022 and, the COVID lows and, but all of them snapped back immediately. You and I cut my teeth in the late 90s, early 2000 bear market, and then got, hammered again in 2008, although I was a smarter trader then. But I don't think a lot of the current professional investment community and the retailers who are into stocks, I don't think they've been through what we've been through.
I think you're right. And, I started in the mid 2000s, so I traded through the 2008 great financial crisis.
Yeah.
I mean, not only retail hasn't seen it, but to your point, money managers haven't seen it.
A lot of money managers.
Professionals haven't seen it.
Yep.
They just have no frame of reference for it, which is a little scary for somebody like me and maybe probably like you who have seen it.
Yep. So when we're in an established trending market like we are now, and there's a pullback going on, one of the things I like to look at is the buying pressure. Now, I will tell you that Bitcoin's buying pressure had been really good until a couple of days ago. But the move to the downside, particularly in the last hour of trading, had a high enough volume behind it to move buying pressure down pretty quickly to, now neutral plus is certainly not a disaster. That'd be Chaikin money flow above 0, but no longer above 0.1. And so we'll call it positive neutral. And that's a big decline. It was FOMO level money flow just a few days ago. So Bitcoin has gotten hammered here in the very near term, and we can go over and look at the nearest term market forecast metrics, which are factors 9 and 10. Think of factor 10 as the day trading time frame, and factor 9 as sort of the swing trading time frame. So very short-term time horizons, but they're important because these are, Double A, you like to use the relative strength index or the RSI, right?
Yeah.
To determine you're overbought, oversold.
Yeah.
Yep. Yeah. So imagine that you could break up the RSI into, or having a different RSI for different time frames. That's kind of what the market forecast oscillator, which is this proprietary Thinkorswim / Charles Schwab oscillator, that's really what it's doing. Right. It's essentially looking at the fear and greed of different types of investors, from day traders to and swing traders to position traders like you and I, meaning kind of a weeks to a couple of months time frame where we're trying to extract 4 to 15% returns out of smaller time frame rips in the market that lasts a few weeks, right? That's kind of our sweet spot in trading. We're also option traders, and that's that 45-day time frame. I call it the intermediate time frame.
Yeah, we like to diversify our strategies.
Yep.
Yeah.
And then the long-term forecast, which is basically for people who are in that kind of months to a year or more time frame. These are all trading time frames, not to be confused with investing, where you're worried about, the average returns that markets give over years. This is for people with trading accounts that move in and out of securities. But each bucket is a different time frame that comes with different rules.
Right.
So we like to know what's going on in the time frames that are below, meaning shorter, and above our time frame, which is 40. What did you say? 45 to, maybe 90 days. That's sort of my sweet spot.
Yeah, I agree with that for the most part. Yeah, that's
Yeah,
usually
if
what
you're long a call option, you want to give yourself enough time for the theme to play out. So you might be buying a call option that's in the money 90 days with an expiration of 90 or even 120 days from now. Sometimes I'll do a full year.
I was going to say, I've learned over the years, it's always better to give yourself more time than you think you need than to not have enough.
Yeah, that's right. And we like to, buy longer dated call options to express a theme, and sell shorter dated call options to kind of pay for the biggest problem with option trading, which is time decay.
Right. Yeah, I was just say that theta will eat your lunch.
So that's why cheat sheets, you got to pick a lane. And so the lane I chose when developing cheat sheets is for active traders, active investors that are looking, that are measuring their return performance on a quarterly basis. And that's where we're at.
Okay.
So we want that intermediate market forecast to be bullish, very bullish. In an ideal world, either a good, even neutral plus can be good, especially if we are reversing from a bearish scenario. But when you can kind of pair that intermediate market forecast and buying pressure, and you really want both to be bullish or better if you can, that's sort of the sweet spot or the foundation for intermediate trend following. Now, going back to the shorter term timeframes, when we see day traders and especially swing traders starting to dump things so that when our market forecast oscillators are flashing a danger zone, that simply means that the momentum is in that lower quintile of possible outcomes.
Mm-hmm.
And again, that's what it's about. It means high momentum, downside, bearish trading going on in the shortest term timeframes. And that can lead to contagion. In fact, I argued today that for Bitcoin, what started out as basically bearish momentum. So, day traders were dumping their stuff. They weren't, not only were they not interested in holding overnight, they weren't interested in holding intraday. So somebody's anticipating some news. I think Trump got on and, there's a whole bunch of tweets about the court's decision over tariffs. And there's some arguments that some people on Twitter are making, or X, that Trump has been fairly or unfairly accused of being a caver on some of his economic policies. And we know that Donald is a lot of things to a lot of people. But one thing I think we'll all agree is that he doesn't like to be criticized.
Right. Exactly.
And so there's kind of a pejorative characterization called the taco trade, which says what Trump always chickens out.
Yes.
Right.
Yes.
And I think that got to him today. So he started to talk tough on tariffs. He's pissed that the International Tariff Court, whatever that is,
the Court of Trade, something like that. I forget the exact title. Ruled
against him, and then they immediately filed for an injunction against the restoration of normal tariffs. With the appeals court. The appeals court granted it immediately, and it looks like this thing is fast tracking to the Supreme Court. Bottom line is the market's getting whipsawed by headlines, and Bitcoin is one of the most volatile risk assets we have out there.
I mean, what you've just described is more uncertainty, not less.
More uncertainty, and Bitcoin is more likely to respond to headlines than any other asset class. Yeah. It sort of kind of leads the way. Think of it like the NASDAQ on steroids.
Yeah, yeah.
And so we got our first sign of a potential market timeout. Now, there's a lot more data that would need to unfold to be convinced of that. But if we look at factors 9 and 10, and we see that in the swing and day trading timeframes, in the context of a short-term trend being bearish, that the risk of, when I say contagion, don't get this confused with some kind of systemic, widespread financial contagion. I'm simply referring contagion into the time frame we care about,
right?
Which is the intermediate forecast. So you get enough downward pressure in your junior time frames, then the intermediate forecast can move very quickly from very bullish to bearish. And when that happens, that simply means we could go from, instead of expecting another leg up or breakthrough from, all-time highs to, to some kind of corrective measure, either a pullback or a multi-month sideways move, which are both possible.
It's just the fractal nature of markets, right?
You got it.
Yeah.
So think of factors 9 and 10 as your early warning signal. Just before we got on the market, AA asked me about a hailstorm that went through Austin. It was dropping 3-inch hail. And he was very concerned for me, especially as someone who just got, their homeowner's policy changed from a 1% deductible event for hail damage on your roof to a 2% of home value deductible. And I was sweating that out and looking at weather radar very closely last night. And, as the storm was approaching my house, think of it like the momentum and near-term forecast were expressing danger zone. But you could extrapolate, and it looked like the prevailing winds were going to take that thunderstorm, which I guess did a lot of damage in other parts of Austin. But the intermediate term didn't play out, so my forecast never got particularly bearish. I just happened to be a little bit west of where the hail went, so I was sweating it. But that storm could have veered, and it could have rolled me over and cost me a roof. So that's what I would argue when you start to see danger in factors 9 and 10 as a trend following trader like we are. That's the concern, is that you move from severe thunderstorm watch to warning.
Yeah, it's funny. Momentum doesn't necessarily mean it will a negative effect on price, but it's a warning of.
Right.
Yeah.
Yep. So as it stands right now, one thing we can pretty much count on is that when we get slammed to danger zone in one day with both factors 10 and 9, that means this is a fast moving puke. And I'd say there's a good chance we're gonna gap lower tomorrow on Bitcoin or overnight on Bitcoin.
Okay. It
doesn't happen always, but it's about a 70% probability based on my experience.
Okay.
All right. So that's Bitcoin. Now the rest of the markets, I think Bitcoin, trades outside of normal hours. And I think the ETF, I ran this data, 10 past the hour. We're going to close today's video with futures as of an hour after market close today. Okay. I did capture those. Okay. So I'll speed up here, but the Qs, actually, the one thing I would tell you here is that we are in a corrective short-term downtrend on Qs and SPY, but buying pressure has gotten better. And I would draw your attention to the other thing that we're going to look at, which is the long-term market forecast, which finally went from neutral plus to bullish on both of those. And that's a big deal, but let's save that for when we look at the chart.
Okay.
Gold's been in a multi-week consolidation. I don't think it's done much since mid-April.
No, and I'm sure we'll look at a chart there too. There's a lot of interesting things to look at on the gold chart, but it still looks bullish. Like there hasn't been any real damage done to the trend. It's like you said, it's traded sideways for some time, but it really hasn't done much damage to the chart.
That's right. We still have very bullish buying pressure. And when you look at the futures, it actually didn't look quite as good as the ETF. So there is, there's a little bit of a disparity between the spot price as expressed by the futures and gold, the ETF. And there's a little bit of manipulation that can occur in the ETF. But in general, the forecasts on gold are slightly bearish. So, gold is just in the first month of what could be, after a huge rip to $3,500 an ounce, it could be that gold is going to, continue a flat timeout for a little while longer.
Right.
Might even pull back. And if the market rolls over, gold will roll over with the market, because the, margin calls require people who made a lot of money on gold to, the market maker will force any margin call. They'll force you to sell your good stuff.
Yeah.
In order to pay for the bad.
In those situations, you sell what you can, not what you want to.
That's right.
Yeah.
Now, bonds are the other thing we're going to look at. The TLT, as we mentioned, has been just horrible. It's been in a multi-month, if not multi-year downtrend. The one thing I would say is buying pressure has gone from extremely bearish over the past 2 weeks to slightly bullish. Now, it's by no means a FOMO level of bullish, but that buying pressure and now the intermediate market forecast has turned slightly positive. There could be a little bit of mean reverting going on, meaning rates coming in a little bit, because they've been obviously big headline news here the last couple of weeks, right? Where the 30-year Treasury You just have to remember that when bonds go up, yields come down. And so a lot of times the newsmakers will express bond price action in terms of yield, and that can be confusing, right?
Yes.
The 10 years up again. Well, that's not the bond price, right? Double?
Right. That's the yield. Right. Yeah.
Yep. So the bond market and traders and financial gurus seem to be thinking right now that 4.5 is a bit of a line in the sand for the 10-year, meaning 4.5% yield on that bond and 5% for the 30-year. And we've definitely pulled back from those levels here in the last couple of days, and you'll see that on the chart.
Yeah.
So slight little bullish flight to safety that is taking a little bit of the bullish shine and putting a bearish sheen on Bitcoin, Qs, and SPY. And you can see that in factor 3. What's important to know is that factor 4 is still not collapsed, but appears to be a transition. And there's also a slight transition, at least in terms of the intermediate weeks to a few months outlook for TLT is slightly better than negative now. All right, so that's the cheat sheet metrics. Let's show you some of the charts. And what the goal here is to show you how we take this data and simplify it into 2 colors.
And just real quick, Mike, this looking at this data table, this makes complete sense to me when you pair it with what we said earlier about retail being a major driver.
That's right.
Of the rally, is because retail is in Bitcoin in the Mag.
Yeah, they're going to panic out of it.
Yeah, but they're in all of these things, or at least the top 3 things are very retail oriented, right? Because the weighting of the indexes and so forth. So yeah, it all makes sense to me.
Totally agree with you. So let's take the QuickView charts, which is sort of some code that I wrote. Well, I didn't write it. AI wrote it for me. I just spoke to it in plain English and it put the codes together. I like that. And I think this is one of the most powerful indicators that I've got in my whole system, and it couldn't be more simple. It's basically a background color that's based on the long-term market sentiment, which is basically the long-term market forecast. And let me just kind of show you what it looks like. And it works pretty well. You're not going to get it every time, but if you use risk management and you simply look at the major ETFs and make a decision to invest whatever your per position allocation is with good risk management, that when that background turns green, you're in. When it turns red, you get out. And a few times you're going to get whipsawed, like between February 3rd and February 10th. You can see that was a trade that probably lost a little money. But the goal is is when you see things like on April 28th or just after or just before that, where we went from a red background to a green background, you can see that price has been going up, not in a straight line ever since. Now today, we actually got a little black stripe. Do you see that on the right-hand side? And you'll see occasionally a black stripe in between the color schemes.
Yeah, I do see that.
Yeah, that's an indication that the color could turn.
Okay.
Right? So it simply means that the triggering mechanisms, I'm not going to get into that yet, created the possibility that the chart could flip colors tomorrow. There's always this kind of one-day transition between colors. Sometimes it's a little longer if the one indicator stays flat for more than one day, the color will stay black.
Okay.
So think of it like a transition zone, heads up, we'll know more tomorrow.
I love it. Simple's best.
Yep. So that's the green background, and there's only 2 options. Red is bad for bulls, green is good. You'll notice a little squiggly line underneath the moving average there. That's simply a potential exit point. So if something turns green in the background and you decide to get in, at least in my system, I like to, stop losses are everyone's got a different system. Mine is simply to look at slightly below the 40-day EMA. And so when I get a transition to red and or price just absolutely collapses and hits that dotted line, I get out. And that's the simplest investing system that I know of, and it works about 70% of the time. Now, does that mean your expectancy is always positive, even with a 70% win rate? No, because you can get whipsawed into little green patches like the one you see beginning February 3rd that lasted, exactly a week and a half.
Yeah.
You can get whipsawed out, and that would represent, 3-4% loss in your portfolio. But if 70% of the time you're making, 5 to 10%, 20% returns, and 30% of the time you're getting dinged 4 or 5%, that can add up over the long term.
Yep.
So it's a really simple system. It's good to back test it, and I'm going to show you what goes into that system. All right.
Okay.
So that is a long-term months to it's a 3 to 18 month kind of window of what to expect. You have to have extremely bullish economic conditions, trading conditions. Everything needs to be going up to get 18 months out of this. But very typically, you can get 3 to 9 months. Not always, but more often than not, 3 to 9 months when something turns green. All right, and we'll get into what powers that. Then you'll notice that a shorter term time frame, now a daily time frame, that really captures the intermediate trend. So the green-red system is, months to maybe a year, a little bit more than a year. This is a few weeks to a couple of months, 3 months. And essentially, for trend followers here, it's the 40-day moving average and a couple of other factors kind of rolled into one color scheme that gives you a lot of information. But green is good, red is bad, and yellow is neutral.
Easy enough.
Yep. And then there's going to be some nuances, which we'll get into next. All right. So this mosaic of indicators underneath this basically drives the green-red system. So let's take this one at a time. Let's go down to the very bottom, AA, and talk about shaken money flow.
Okay.
So money flow can best be described as price related to volume. Good money flow is when price goes up a lot and it closes near the high for whatever the time period we're measuring. In this case, it's the trading day. And you want to see price near the highs with high volume behind that daily candle. That gives you the best shaken money flow score you could get. And the reverse would be true if people are puking up stocks into the close or whatever the security is that we're measuring at high volume, closing near its low. That's a bad money flow.
Yeah.
And then money flow, any one bar in money flow is looking at the past 21 trading days. Okay, so it's a bit of a lagging indicator, but you kind of need that because you need the pattern over at least a reasonable period of time. And for the intermediate time frame, I think a month's worth of data is pretty good.
Agree.
Yep. And then we know, AA, that what we really want to see is a persistent level of money flow. And so we want day after day after day of strong money flow.
Right.
And we use some parameters. First of all, above 0 is positive money flow. Below 0 is negative money flow. But, 0 to 0.1 or 0 to negative 0.1, that's really a neutral range with a slight bias in one direction or the other. So you're going to see money flows generally don't get much above 0.6, 0.7. You have to be kind of a narrow stock or a narrowly focused ETF to get that and be heavily in favor. You very rarely get a money flow much above 0.5 on a major index ETF like SPY. So think of the money flow as anything in between negative 0.5 and 0.5.
Okay.
Anything that's lower than 0.1 or higher than negative 0.1 is going to be kind of neutral. We call it neutral plus if it's above 0, neutral minus if it's below 0. But really, we're splitting hairs here. That's not a lot of institutional conviction either way.
Mm-hmm.
One other thing about money flow is, listen, I know retail is a powerful force in trading these days, but money flow more often than not is something determined by big money, right? People with deep pockets.
Hedge funds, banks, institutions.
Pensions.
Yeah.
Sovereign wealth funds.
Yeah.
Billionaires. So the big players are the ones who control the supply and demand curve in the market. And we little minnows love to follow them in or out of trades. out of the market. And so when money flow is going up and we're above 0.2, we consider that to be a FOMO level of money flow. So that would be very bullish. And the higher above 0.2 you are, the more bullish it is. Between 0.1 and 0.2 it's not FOMO level money flow, but the institutions are definitely buying.
It's bullish.
Yep, it's bullish. So 0.1 is our sort of our cutoff. And it doesn't mean hand over fist buying, but it means consistent accumulation. That's another word that can be used. Buying pressure, accumulation. And so when you see splotches of bars that are north of that red line, again, we're looking at the very bottom indicator here. You can't see my cursor, can you? If I
No, I see it. Yeah, we see it.
Oh, you can see it. Okay.
Yeah.
Well, that makes things easier here. But this is a good month of solid money flow that increased for the most part. Now we're drifting down here a little bit, but nothing obnoxious. But that money flow is corresponding with what? Price going up.
Price
and
going up,
the green zone. Now the money flow doesn't determine the green zone. It does have an influence on the green line here, which I'll explain in a minute. So money flow above 0.1, you're bullish. Above 0.2, you're very bullish.
Got it.
Above 0, below 0.1, you are neutral plus. And then think of the bearish spectrum as the exact opposite of that. So when we saw the headline-driven Trump tariffs, I remember, and I was a little embarrassed at the time, I wrote on, I think it was 4/1, that based on the money flow we were seeing going into that Liberation Day announcement, that the market wasn't going to crash. Now, it turns out that the market was surprised by the news, and it did crash, but it was, again, a headline-driven crash, unexpected by technical analysis is never going to factor a surprise.
Like the sum of technical analysis is all known information, right? So the scope of that was unknown at that time.
Yep.
Yeah.
So obviously, if the administration had stuck to that policy and implemented it on that timeline, that would have been a change, and it probably would have crashed the market even more than it did. The 20% we went down in a week or whatever it was.
Yeah.
But going into that, based on the much deeper spectrum of macroscopic data, the probabilities were that the market was not going to go down and stay down based on that. If price is a function of what everybody who participates in the market knows, and I'd argue there's a ton of inside info getting traded around among the big money players, that it was not an unreasonable bet to stay risk on into that announcement. And for those who didn't panic out at the lows, were rewarded.
Yeah.
Or who bought more at the lows were rewarded. Now, we did get a dip in money flow, but it never got down to those horrible levels. And I think we had a day or two where we were below 0.1. We might have even gotten near 0.2. It certainly didn't last, though.
Oh, it was short.
And the money flow recovered. Now, it did not get extremely bullish, at least not in the U.S. And if you can see my cursor, between the second week in April and really the first week in May, we had very anemic money flow. Most risk assets that benefited from the Liberation Day reversal were ex-US funds, gold and Bitcoin. So it was alternatives to US stocks.
Yeah.
But eventually that rally just continued. And, here retail was buying the dip, but institutions weren't. And then I'd say institutional FOMO started kicking in early May when they realized, oh my God, we're so far behind where we need to be. Whoops.
Well, it's kind of an interesting dynamic. Like the script has been flipped a little bit because, with retail piling in, with enough force and enough buying pressure to push the index higher, now the professionals are being forced to chase the retail rather than retail chasing the professionals, which is the way it's been in, up until at least recent time. I find that fascinating.
Absolutely. Okay, so let's put a pin in money flow. And we're not going to do every stock at this detail, but I think it's just kind of important to see where we're at. So money flow on the SPY as of right now, it dipped just slightly the last couple of days from FOMO level to high bullish. So we're at 0.186 as of the close. And I think we might have drifted a little bit lower in the after hours today based on the news. But so that's where we're at. So still pretty bullish on the major large cap US index in terms of money flow. Let's come up to here. Those 4 factors, 7, 8, 9, and 10 on cheat sheets are all expressed with each of these different colored lines here. All right. So the longest term market forecast indicator, remember that one that I said was 3 months to maybe a year and a half ish? Yeah. That's expressed in this yellow line. Think of this as the prevailing wind. So, for example, there are weather systems that can travel east to west, though it's really hard to do it because most of the time in this country, the wind movement is from the west coast to the east coast, right? Weather patterns drift from west to east, and it's really hard to fight that. So, like if you get on a jet plane, you'll notice that when you travel from LA to New York, it's always a faster flight because you get the wind at your back. Yeah. Compared to going east to west.
Going with the jet stream.
Yep. So think of this as the jet stream. It is the most important of the factors here. This is momentum on a weekly basis. So think of this as the one time frame that sort of reflects all opinions from investors to day traders, right? Because you're rolling up all of the different time frames and expressing it in terms of a weekly market sentiment. And so when that yellow line is drifting lower, even if you've got some subsets of traders in more junior time frames exuberantly trading a bullish trend in their time frame, when that line is drifting down, it is a headwind. And it simply means that it does not mean that everything is bearish. It simply means that rallies are going to last a shorter amount of time in any time frame, and they're more likely to fail or be affected by unexpected news developments. Just things don't work out as well in that type of environment.
It's a bit of a clue to reset expectations.
Yep. Now, one of the things you have to pay attention to with the yellow line, and we do this with cheat sheets by characterizing it, is that the yellow line, like all of these forecast oscillators, move between 0 and 100. And it's an expression of momentum for each of the time frames. So the yellow line or mustard colored line would be the months, multi-month. Think of it as months long extrapolation of what's likely to be the market momentum moving forward. Now, when we're above 80, it means that we're in the top quintile, or I guess quintile, right? 0 to 100. Each kind of time frame we measure is 1/5 of the total spectrum of time. Okay, so listen, you're a B student or better if you're at 80% or higher. So this is the top 20%. And when the yellow line is that high, we don't really care about which direction it's moving in. It's inconsequential. It's sort of like the difference between somebody who got a 93 on their paper and somebody who got a 91, right? You're still an A.
Yeah.
Okay. But we do start getting concerned when we break below 80. And we get concerned, even more concerned, when we break below 50. And we're especially concerned when we break below 20. And so those are the lines of demarcation for our cheat sheet assessment of the longest term. Factor 7 of the long-term market forecast is that we can be very bearish, which means we're under 20. We can be bearish, which means we're between 20 and 50. So basically anything under 50 is bearish. We can be bullish when we're above 50. And we can be very bullish when we're above 80.
Yep.
Now, the most important place for the market sentiment to be of all of those time frames as a bullish trader, the one where you're getting the most assurance, it's where you're getting the most amount of information. Trading is always, risk and reward is always balanced by how much information a trader has. So when that oscillator, this, the multi-month time frame oscillator crosses above 50, but it hasn't yet moved above 80, of all of the quintiles that momentum line can occupy, there is nothing more powerful than a cross above 50. And we saw that this week. Now, the week isn't over. Let me be clear about that, right? You want to think of these, even though this is a daily sentiment indicator, you really want to look at it on Fridays. When the week completes. If we've crossed from below 50 to above 50, which we did this week, or we did late last week, I'm sorry, I don't remember. There was a holiday that screwed it up. But a transition between 49 and 51 is probably one of the most powerful indicators in the cheat sheet system, because it's the sum of opinions in terms of expressed trade momentum in multiple time frames. And when you go from below 50 to above 50, it means you're suddenly in the majority of market participants are trading bullishly.
You're saying that line represents a lot of votes.
Yeah. And again, it's not just hopes. It would be putting your money where your mouth is.
Yeah. Votes with a V.
Oh,
vote.
votes. Yes, not hopes. Yes. Yep. And so we call this the intermediate trend progression. For those of you who are premium subscribers and you get our trading signals, this is a stage 2 intermediate trend progression. It's the best one that we have. It's probably the best trading signal there is of the 9 for a multi-week trend follower. And if you compare that with buying pressure above 0.1 or shaken money flow above 0.1, and particularly at or near 0.2 or better, that combination is pretty powerful. So despite the fact that we've been weak the last couple of days and we're pressed up against resistance, if you asked me, put a gun to my head, and I had to place a bet on either bullish or bearish a month from now, I would, now again, it's not guaranteed, but I would choose bullish, because that particular transition from neutral, I guess it would be, we don't do, I don't think we do neutral plus and minus on the market sentiment. I can't remember now, but it's from neutral to bullish.
Mm-hmm.
That simply means we're going from below 50 to above 50.
Yeah.
And then, so here's the other thing is, once we get above 80, it still means that the market could run for several more weeks, but you are closer to the end than the beginning. Once this thing gets above 80, it doesn't stay above 80 for very long. Now, that doesn't mean a day or two, but definitely weeks to maybe a month, maybe 2. You are closer to the end than the beginning. And that's when I like to sell covered calls or buy puts or start layering in hedges, is once we're above 80, because I know we're not going to stay there for very long. There's going to be a reversal and or a multi-month consolidation, sideways trend, something. The momentum is going to be halted.
Again, at that point, most people are on that side of the boat, so it's going to be hard to get more people on that side of the boat if they're all already there.
Yet at the same time, those last few people are piling in.
Yeah.
And that's where, generally speaking, except for this, the narrative currently is that retail bought and institutions were asleep at the wheel. Well, institutions may still get the last laugh here.
For sure.
As far as this rally goes.
Yeah.
But you will find institutions probably not selling to retail right now, unless, of course, something major changes, like Trump has figured out how to, overcome his anger about the taco. Trump always caves. That characterization, he does something draconian and the courts back him up. Obviously, the market's going to give up its gains. So you can't plan for that. What you can do is look at the probabilities based on the indicators.
Okay.
All right. So let me jump down in time frame and speed this up a little bit.
Okay.
So the green line is similar, but I like to use the football metaphor for this one. So when you have a market sentiment / forecast oscillator in the long term, going from 20 to above 80 over the course of many months, you can have several trips of the green line, which is our next time frame down, and it's the time frame that's most important to AA and I. The green line can move from low to high, generally between 1 and 3 times, but it's more often than not once you get above 50, you can expect more than one journey of that green line, meaning the intermediate trend can go up and then consolidate and up again and consolidate and usually up again a third time. You've heard that expression, the A, B, C, D, E, F, right? The 3-wave impulse.
Yeah. Oh, yeah.
For markets. Well, if you think of the market sentiment line as the prognosticator for the 3-wave impulse and the market forecast on the intermediate term, the green line, being the impulse wave itself, think of this as potentially 3 round trips from below 20 to above 80, up to 3 round trips. And so this is what we like to pay attention to. Now, when the green line is moving higher, and we need it above 20, remember what I said, that when you're below 20 or above 80, movement really doesn't matter. You're either in the lowest tranche, you're in remedial reading, and I don't care if you get a 10 or a 12 on your score, you're still in remedial reading. Once you're above 80, you're in honors, calculus, and yeah, you outrank a class member, but it's you're not going to marginally make that much difference. But when we're moving in between 20 and 80, and this is where I like to go from, instead of using classroom grades, I like to use football as my metaphor. So think of the green line as whether or not you're on offense or you're more defensive. That'll be the difference between being above 50 and below 50. Think of the green line being above 80 as in the other team's end zone, meaning you put points on the board. If you're below 20, you're either getting scored upon or you're fumbling in your own end zone. Okay.
Yep.
So the most anemic bullish reading we have for the intermediate market forecast would be across from below 20 to above 20. You can see it happened right around Liberation Day. Or should I say just after Liberation Day, right? We got this move. Think of this like taking over on offense, but you're on your own 2-yard line. Right. So you have to be worried about getting sacked by the other team. And of course, if you get sacked in your own end zone, not only do you lose points, but the other team gets the ball back. But once you cross midfield and you're across that 50-yard line, well, suddenly now the chances that you'll put at least a field goal on the board, they go up dramatically, right? You're less worried about a pick six and much more worried about, completing a pass into the end zone and or kicking through the uprights to put points on the board. So our version of that is if the market forecast oscillator is below 20, we're very bearish. You do not get more bearish. The answer is how much more bearish? None more bearish. If you're above 80, you're very bullish. You can be none more bullish. Now, by the way, the difference between the market sentiment oscillator being above 80 and the green market forecast oscillator being above 80 is that can stay pinned above 80 for quite a while, weeks to months. So the journey is usually shorter from 50 to 80. The time in the 80 zone is much longer, so it's less of a impending reversal signal, like a stochastic. Stochastic can be above 80 for forever, right? Even the RSI can be above 70 for quite a long stretch.
Yeah.
Okay, so very bearish is below 20. 20 to 50 is bearish. And by the way, it depends on the direction too. So I'm talking about a positive direction here. 50 to 80 is bullish. Above 80, moving in any direction is very bullish. Okay. The sweet spot again would be cross above 50. Cross above 50, especially if the market forecast long-term oscillator is also going up. That's as good as it gets. And I would argue that while we certainly were above 80 when the market forecast oscillator in the longest time frame transitioned from below 50 to above 50, this is very bullish. Very bullish to have both indicators no worse than bullish. And in this case, intermediate forecast is very bullish. The long-term forecast was transitioned from bearish to bullish. So if the green line is going up in between 20 and 80, we like it. If it's going up between 50 and 80, we love it. If it's above 80, we like it. So again, 50 to 80 is the sweet spot, but above 20, if the market forecast longer term is in your favor, not a bad thing either. All right. So that's sort of kind of a review of how these work in tandem. Now let's explain the colors. All right.
Okay.
So in order to go from red to green, you just need this market forecast oscillator to cross above 20. So if you want to be really safe, you wait for that market forecast oscillator, meaning you have to do some more work than cheat sheets will give you. But if you see a market forecast oscillator transition from, meaning now we're in the longest time frame, transition from very bearish to when we're below 20, we're very bearish. When we cross above 20 and we're moving up, we move to neutral plus, and then above 50, we're bullish. So between 20 and 50 is a little bit more risky. But you will turn green on a neutral plus rating of the market forecast oscillator. So it's stronger when it's bullish. And this, again, I'm referring to the longest time frame. Okay.
Okay.
And that's really the difference. Now, of course, once we cross below 80, we're neutral minus. When we cross below 50, we're bearish. And when we cross below 20, we're very bearish. The market forecast oscillator, once it crosses down below 80, once again, moving stops, selling covered calls, adding bearish positions, although they shouldn't be the majority at that point. Those are all good hedges when you see a market starting to lose its long-term market forecast, okay? And that would be a transition from green to red. Green line correlates to the exponential moving average, and that's the 40-day exponential moving average. In order for that line to turn green, and now I'm talking about dark green is slightly weaker than bright green, okay? 3 things have to be true. First, price has to be up and above a 40-period moving average that is increasing. And you see that here, right? It turned green. You see price moved above, went from below to above, and the line went from flat to pointing up. You see that?
Yeah.
Yep. So that's requirement number 1. Requirement number 2 is money flow needs to move from, it needs to get from below 0.1 to above 0.1 in order for that green line to occur. Just measuring it here, it looks like it did it either here or here. Okay, so it turns green, money flow has to be above 0.1. And the third thing that must be true is the market forecast oscillator must be above, I believe, 50. Don't hold me to this. It might be above 20, but I believe it's above 50. Here, let's find out. Let me give it to you exactly. All right, so in order to get green, yep. So price has to be above a rising 40-day exponential moving average. Money flow must be above 0.1, and the intermediate line must be above 20 and rising or above 80 moving in any direction. Okay, so those 3 things are a requirement for green. In order to move from just regular old green to intensely bullish green, I've just moved to the QQQ now, just to change this up a little bit.
Okay.
Money flow has to get to 0.2, and the intermediate market forecast line has to cross above 50 and be rising and or be above 80. So you need a better, more bullish intermediate market forecast and stronger money flow. So that's what happened here. Price is above a rising moving average, and money flow is above 0.1, and the market forecast oscillator is above 20 and rising. Once we transition from, so that's to get you from yellow to green. In order to get from green to bright green, money flow has to be better than 0.2. And the market forecast intermediate oscillator needs to be above 50, okay? Which both things were true here when it turned bright green. When you have that and you have the scenario of market sentiment, the longest term momentum indicator we've got rising at above 20, you have a green-green chart situation. So a lot of data, but now we've simplified and dumbed it down. And there's a lot of different ways to trade this. I'm still a big believer in when market sentiment is green, I look next at money flow. And if I see that's green as well, meaning in my head, sorry, bullish, then I'm all in. I don't wait for the line to get bright green. I just know that green background and money flow above 0.1, and especially if it's above 0.2, I'm seriously looking at trading that in some way. All right, a lot of data to take in. So let's just look at the markets now and not get into the nuances from here.
Okay.
The NASDAQ. The one thing you'll notice that we had kind of a, what would you call that? A piercing line, wouldn't it? It would be a dark cloud cover candle.
Oh,
right?
yeah. Are you talking about today, the latest candle? Yeah.
Yep. So at resistance, we tried to break through, and they sold it into the close here, and money flow transitioned, I believe, from very bullish to bullish. Okay. And or the market forecast oscillator fell out of the picture. It still was good enough to be green, so I suspect money flow was the issue here. But we lost the bright green. We held on to our market sentiment background, and we're still green here. This is still a buyable pullback. We probably get some type of buy the dip signal tomorrow if I were to run the numbers. But let's see what happened. Market sentiment actually crossing above 50. So this suggests that this consolidation is a buying opportunity. That's the first thing I'd point out. Money flow has come down from a FOMO level of 0.4 2 weeks ago to just under 0.2 now. So that's what caused this bright green to green transition, just a dip in money flow. Notice the market forecast oscillator stayed in above 80, so it did not transition. And we haven't talked about this yet, but danger zone, this red line has to get below 5 in order for a danger zone in the momentum time frame to trigger. And the blue line, in order for its danger zone to trigger, it has to get below 20. Neither of those things happen, which suggests to me a buyable pullback here. That doesn't mean it's not going to continue to go down, but it just means that as of right now, we're not in danger of a massive market collapse based on the data.
Okay.
All right. Bitcoin's a different story. Bitcoin, you can see AA. We had, first of all, high volume and a downprint on the day. Started out higher and then finished lower. We're using the ETF here, so this is not the Bitcoin spot price. So market sentiment still okay. But we've gone bright green to yellow in a pretty fast time frame, which probably reflects a drop in money flow. So we can take a look. And this will be a chance to really explain the danger zone here.
Yeah.
All right. So we pulled back, but we're still above a rising 40 EMA. So factor one, not an issue for our green scenario, which means either the intermediate market forecast broke down or money flow did. Intermediate market forecast is still bullish, very bullish. In fact, it's above 80, moving in any direction. It is pointed lower, but it's not an issue yet. But look at money flow has just collapsed.
Yeah.
It's gone from, above 0.3 7 trading days ago to barely above 0. So someone's puking up and panicking on crypto here right now. Momentum in both the intermediate and short-term timeframes. These are the market forecast oscillators, factors 9 and 10. See that blue line and that red line here in the shorter time frame market forecast area? Both collapsed under their respective levels that triggered danger zone, which suggests we're not done. Bitcoin is basically clearing some overbought conditions here, or we're worried about contagion. Contagion to the next time frame would be if the momentum continued lower, gets to that green line below 80, that would transition us from an intermediate market forecast that's right now very bullish, above 80, to neutral minus. That's when we fall below 80 and we're pointed lower. Okay. Or you can just look at the charts, right?
Yeah.
What these charts tell you is if you're expecting a tradable bounce, the yellow would dissuade you from that. If you're just trying to accumulate through some type of more complex consolidation, probably not a bad place to acquire a little Bitcoin, but don't expect a trade above the high of the low day tomorrow with a transition from bright green to yellow that fast. Longer term investors, buying opportunity. Momentum traders certainly be more worried about bearish price action from here than bullish. If you're an intermediate trend follower getting mixed signals, it suggests staying on the sidelines and waiting for more favorable conditions if your time frame is weeks to a month or two.
Your particular time frame is everything, right?
Your particular time frame is everything. Speeding this up, gold has been in a multi-month consolidation, but it did make a key transition from green to red, which means that the market sentiment, the longest term, factor 7, moved from very bullish to neutral minus, meaning it crossed below 80 and is pointed lower. Now, that's not nearly as bad a headwind as when it crosses below 50 and gets bearish.
Yeah.
So again, it is worth looking at other indicators than just simply the oh my God, I'm going short because it turned red. A lot of times that can be a problem. A lot of times when it turns red, but it doesn't get horribly bearish, this happens. This is why it's harder to short these transitions than it is to buy them bullishly.
Mm-hmm.
But what you can typically expect is a multi-week to multi-month pause in a longer-term uptrend if we move from green to red. And so I would expect this gold consolidation is not done yet. Yep. The fact that we've lost momentum from bright green to yellow tells me some other lower time frame momentum is broken down, and then we can look at it and see. So here's your transition of market sentiment from above 80, where we don't care what the direction is, to below 80. So 75 is still not a problem. Once it drops below 50, we're much more concerned. Now, a much bigger concern would be the series of lower highs on the intermediate oscillator and the general direction pointing lower.
Right.
So now we have two time frames, the longer term time frames, slightly bearish, and the intermediate time frame, slightly bearish, but risking transitioning from above 50 to below 50. If that happens, we could expect potentially a breakdown and a much more serious type of correction than the sideways movement we've seen. So we have to watch that very closely. Now, what gives me hope that that's not going to happen, AA, is the fact that money flow, at least in this mostly retail-driven ETF, is still very FOMO-y at 0.25. Yeah. So we're not seeing these time frames, these momentum oscillators are not being experienced with a coincidental breakdown in money flow. However, I think it's important with a commodity like gold to look at the futures. So at the very end of our recording today, I'll take you through that.
Okay.
Get to look at the futures. All right. Finally, treasuries. I'm going to let you do more of the commenting on treasuries here, because we definitely have a very bearish scenario where we've got red background, and we've moved from bright red to yellow recently, which suggests that the shorter to intermediate time frame may be softening a bit. That's what you can take out of this, but by no means does this suggest the trend is imminently about to reverse.
Yeah, I mean, the trend is clear here with lower lows and lower highs. Like that's been the case for some time.
This looks like a retest of a very important former support level, now acting as new resistance. Yeah,
and at least on the futures, again, talking about futures rather than the ETF, it's just been trading in a tight range for a couple weeks now. Yeah. And money flow has been pretty anemic, really, for some time in the treasury market.
And we have had some, how do we call it, not QE going on.
Yeah, by the Federal Reserve slowing their pace of their QT program and quantitative tightening, it's allowed them to buy more from the Treasury just to maintain the size of their balance sheet once they account for roll-offs and things like that. So, and man, they jumped in with that last month. I forget the number, but it was like
50 billion.
50 billion. Yeah, I mean, it was not insignificant. And so to think that if the Fed had not reduced their QT program, who would have sopped up
that's right,
those billions, right? So,
and I think Bessent accommodated by offering while we certainly had longer duration treasury auctions, I think most of that Federal Reserve money went into the shorter end of the curve.
Yeah, everybody's been criticizing the issuance, the way the duration and the issuance of duration, and
he's doing what Yellen did.
Because that's what he has to do. It's what Yellen did it because she had to.
If you have no buyers for your 20 and your 10 and your 30-year bills, and even your 20s apparently,
right?
But you can sell the shit out of the 1 and 3 month treasuries.
Right.
That's where you go.
It's like we were talking about earlier about, when people get caught in margin calls, they sell what they can, not what they want to.
For those who've been cheat sheet readers, that I've pointed out every possible turn about the data being pretty soft for bonds. And, I've basically made a personal decision to no longer hold a 60-40 portfolio. And I haven't done that for quite a while. But I'm trying to get my gold and Bitcoin holdings, with gold being the bigger asset for me, just because I'm more comfortable with it, I'm trying to get that up to 10 to 20% of my total holdings, and I'm doing it at the expense of long duration bonds.
Yeah, I'm sorry. Go ahead.
Yeah, in an ideal world, I'm interested in now, and I'm retired, so I'm can't take the risk like somebody working can, but I'm still doing a good 40 to 50% stock, but now only about 25% bonds, and I'm trying to get up to 25-ish% gold and Bitcoin. Right now, I'm holding an awful lot of T-bills, short term, because I have to fund my retirement.
Yeah. Much safer, less convexity risk with the short.
Yep.
Yeah.
But even as a retiree, not making much of an income anymore, hey, subscribe to Cheat Sheets and pay me the $5 a month for valuable information, and so I can buy some cat food next week.
And you don't have
notwithstanding, the fact is that I just don't look at gold as that risky an asset when you consider how fiat currency is going to be devalued and the amount of bonds that have to be sold by the US in the future, by Japan, by Europe, by just virtually China, everywhere around the world. We're swimming in debt offerings, and that is going to devalue the debt. And that means that, listen, even if you are getting a 4%, 5% interest rate on that debt, the currency is likely going down at a rate that's twice that. And then you have to add inflation on top of that. I know, several macro strategists indicate 8 to 11% is the average decline in the spending power of the dollar every year.
Right. And then, like you just said, plus then you have to add inflation on top of that, the erosion of the buying power that caused by inflation.
Or rather than seeking a narrative, just look at the QuickView charts. Oh, it's red, yellow. I don't think I should be buying bonds here other than as a mean reversion quick trade, which is, I think, what's going on.
Agree. Yeah.
Here you'll see it.
Bonds are not something that I personally want to be long either.
The market forecast long-term oscillator has crossed weeks ago below 50 and is headed probably below 20. There might be a pause here. It will take serious momentum to reverse this line. Now, when it does, there'll probably be a bond rally, especially if God's honest truth, I'm not long bonds over a multi-month time frame unless I see this oscillator go from neutral plus, which would have to go through first, up to bullish. That cross, again, we call that an intermediate. This would be a stage 2 progression in the longest market forecast oscillator, a transition from neutral plus to bullish, meaning below 40 to above, below 50 to above 50.
Yeah, Oops, right. Okay.
Okay. So here's that. We just took over on downs on our 2-yard line. So we do have a transition of Chaikin money flow from extremely negative to slightly positive, barely above zero. Okay, so neutral plus by an inch. And here we are. We've just recovered the football on the 2-yard line. The market forecast oscillator has moved from very bearish to neutral plus.
Mm-hmm.
Okay, meaning above 20, but below 50. All right. With a strong headwind. Think of this like the other team is able to pour tacklers through your Swiss cheese offensive line. Okay. So the risk of the quarterback under pressure throwing a pick six and or getting sacked in his own end zone is extremely high relative to the opportunity of moving the ball into the other team's end zone. You'd want to see this momentum line, this red line, well above 80, meaning there's a wide receiver out in open field, able to get the pass before you'd even consider investing in bonds in this type of bearish scenario. Or again, it's red, yellow.
Right.
Your choice, how many indicators you want to look at.
Right.
All right. So let's finally kind of go through. This is now the futures of most of the major asset class ETFs. This is the micro futures. So for those of you who are, smaller account traders looking for a vehicle that doesn't give you overnight risk like you would holding ETFs, this collection is probably as good as any. Again, there's always risks with futures trading, so make sure you understand those before you pile in. But here you have Bitcoin futures showing, again, very similar to the ETF, short-term downtrend, but here's where to be concerned. We didn't quite get the danger zone on momentum, so institutional investors and retail traders who have futures access. Certainly the momentum suggests further downside ahead, at least in the short term. And the buying pressure is now only neutral plus, which means we are money flow above zero, but no longer above 0.1. So those are concerning signs that could affect these timeframes and then this time frame. And so this 78 could very quickly become a 45. Or this is a viable pullback.
Right.
We'll see.
Right. We'll
But
see.
the money flow and the short-term momentum signs are dangers. This is certainly not the time to be a hero and say, I'm going to double my bet on this pullback, at least not yet.
Right.
NASDAQ futures, on the other hand, actually, this is a setup for buy the dip where the momentum line did not, it got close to 5, but didn't get to 5. So when you have a bullish or better intermediate market forecast, green line moving up, right, and a momentum line trading below 20 but above 5, that triggers a buy the dip signal in our cheat sheets trading signals. So that's what we'd see tomorrow, I guess, for the Qs, if that holds. Even better is the S&P 500 didn't get close to the danger zone. And yeah, some relative strength issues, but this looks like it's setting up for a bounce. We'll see.
Mm-hmm.
Gold didn't get a neutral, didn't bust into a heads up or any type of bearish momentum setup. In fact, neither did silver. Buying pressure is bullish. The intermediate market forecast is a little anemic. So again, below 80, trending down, but above 50. So this suggests intermediate consolidation continues for both of these. You'd really like to see that neutral minus turn back up to bullish. This is just an expression of the British pound against the dollar. So far, the pound has got a slight upper hand. Ethereum, unlike Bitcoin, didn't go through that same bearish short-term momentum.
Yeah. It's been ETH has been lagging quite a bit, hasn't it?
Yeah, it's been outperforming in the very near term.
Oh, has it? Okay.
Bitcoin, but over months, it's been lagging horribly. Yes.
Okay. Yeah.
It took a much bigger drawdown. I'm going to skip a lot of these because we need to end this video, but the 10-year note is, I think, the most important thing here.
Yep.
I remember when we talk about a 10-year yield in the danger zone in 2 time frames, AA, that's actually a suggestion that bond prices might have some room to move up.
Move higher. Yeah.
Yeah. The buying pressure is not on the bonds; it's on the yield.
Right.
So
okay,
this strikes me as a mini flight to safety might be going on here at the end of the month into June. We'll see.
Mm-hmm.
And the question is, does it become the summer swoon, or does this become just a week or 2-week little pullback before that final summer rally? June seasonally, the last couple of weeks in June are usually not very good for the markets.
Right.
If I remember correctly.
Right. I remember that as well.
I do remember that summer months are generally good in July and early August, but then from late August through September and early October can be a tough period for markets.
Yes. Yes.
And natural gas, we don't trade. That's pretty volatile. Yeah. So anyway, that's a big deep dive into the cheat sheet system. When you see QuickView charts, when you see our stack ranking of tailwind scores, we just wanted to show you the indicators behind that to help you make some sense of it. If you subscribe to cheat sheets at stockcheatsheets.substack.com, there is a user guide that comes with every report that we issue. We send stuff, a lot of days it's free. Other days when there's more interesting or nuanced information that's valuable, we reserve that for our paid members. AA, you help me with cheat sheets, but your main Substack mission is to help those trying to lock a mortgage do so when the 10-year yield comes down like it is now.
Yeah, I write a little a blog on Substack called Macro to Mortgage, not only for consumers but for others in the mortgage space who don't have such a detailed understanding of things.
And where can I subscribe to you?
It's at Macro to Mortgage on Substack. Substack.com.
Okay, great. Yeah. And then I think you also do some videos. Do you have a YouTube channel as well?
I do. Same handle. I've been I've been occupied with other things, so I haven't done a lot of content lately, but hopefully get back into that here in a couple weeks.
And we need to do more videos.
Yeah, that'd be great.
And I think the quick view charts are kind of the way to do it. Just pick 5 or 6 ETFs. We probably won't go through that granular level of an explanation too often. We'll refer back to this video for the a good explanation. I've also got some tutorial videos where my 20 now, he's now 24, but he was 21 at the time, nephew, and I took him through kind of a even more rigorous version of what I just took everyone through here. Hopefully that's just some background info that helps you, or just look for tailwind scores between 60 and 85. Pay attention to buying pressure. You want it to be at least bullish with an intermediate market forecast, bullish or better.
Green good, red bad.
Couldn't be more easy.
That's right.
And remember, taco trading is usually the winning bet.
That's right. Where's the taco trade? Thanks, Mike.
All right. Thanks, Double. And I'll figure out how to turn this recording off at some point. I'm going to start by stopping presenting, and then I will try to figure out how to friggin' stop the recording. Not necessarily intuitive, but I think manage recording and stop recording will do it.